Hi, and welcome to Swissquote's Daily Market Talk. It's Tuesday, October 28th. Encouraging trade news pushed global indices higher on Monday. The rally seems to be cooling today in Asia ahead of the Fed decision and the Trump and Xi meeting later this week. But the Fed is still expected to deliver a 25 basis point cut and potentially announce the end of the quantitative tightening this week. And the US and China are seen closer to a trade deal. So what could go wrong? We will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So major global indices were up yesterday for many to fresh all-time high levels on news that the US and China are inching closer to a trade deal right now that will prevent the countries from imposing triple-digit percentage tariffs on their mutual exports and eventually end trading between them. And today that optimism continues as talks between Donald Trump and Takaichi, Japan's new prime minister, compared to Shinzo Abe, went quite well, actually, leading to a trade agreement on critical minerals. Trump praised Japan, while they both said that this is the new golden age for the US-Japan alliance. I mean, it could have hardly been better than this. And on the Chinese front, investors around the world are now bracing for a good deal between the US and China as well. Maybe not an excellent deal, but still good talks. But fundamentally speaking, still the US and Chinese objectives are fundamentally quite difficult to align. Because the US wants to bring manufacturing back to America, and that would be China's loss, obviously. And the US also wants China to spend instead of manufacturing, a thing that Xi Jinping tried but failed big time over the past years. And China's latest 5-year plan appears to show Trump's rebalancing dream to be, as far as Beijing is concerned, a fantasy, wrote to Bloomberg journalist this morning, that I actually found brilliant and hilarious. But it's very true, and voila, the two leaders will be meeting. They actually appreciate each other quite a lot, and maybe that personal thing between them will keep the relations between the US and China as well as it could possibly be given the circumstances. But I don't believe that any deal or anything that we will hear today will be the end game here and will magically end the Trump policy volatility. That volatility will continue in the next 3 years, but happily though, that's something that the markets and investors got acclimated to since January. So the S&P 500 didn't wait for good news from that front to extend its rally to all-time high levels. As you know, it's doing so since June this summer, while equities in China and in Hong Kong are recovering past year's steep losses as well, with technology names there shouldering the recovery. In Japan, on the Nikkei trades past the 50,000 psychological level for the first time in history. That was on Monday, though we see some profit taking this morning above this psychological level. But overall, the news flow remains positive and supportive of further risk taking. Trade deals with the US are coming in. The Fed and the Bank of Canada are expected to cut rates this week, and the outlook for the Bank of Japan is softer thanks to Takaichi. So what could go wrong? Time will tell, but for now, equity investors around the world enjoy this rally while the safe haven assets are pulling back. In this group of safe haven assets, gold has now slipped below the $4,000 per ounce psychological level in nothing but a healthy market correction to the latest exponential rally. So this correction has room to deepen, mind you. We could see gold prices pull back significantly to 10 to 20% even, which would then bring us to levels last seen just during the summer's peak levels, and that's about the $3,400 per ounce level, which is also the major 38.2% Fibonacci retracement level on the latest 2-year rally. So above $3,400 per ounce level, gold will still remain in the positive trend, with bulls still looking at the $5,000 as the next target. Elsewhere in the commodities space, copper is on a volatile but positive trend, while US crude tested but failed to clear its 50-day moving average level yesterday on trade optimism. Now, the tactical bullish bets here on last week's sanctions against two Russian oil giants, Rosneft and Lukoil, are also being gently closed right now. There are talks, on the other hand, that these sanctions could eventually be less severe than previously thought, as Donald Trump wouldn't want to trigger a price spike in oil markets. And add that the fact that Saudi Arabia is now seeking to increase its market share and OPEC will be bringing extra barrels to the market in the coming months, well, the chances are that the bears here will be pushing for a return below the $60 per barrel level in the coming days and weeks. In the FX space, the US dollar retreats to a week low as the Federal Reserve starts its two-day monetary policy meeting today and is widely expected to deliver the second rate cut of this year, a 25 basis point cut, when it announces decision tomorrow, with rising speculation that the officials there will also announce the end of the quantitative tightening, with some big bank analysts hinting that the QT could even end immediately, as the post-pandemic era's extra liquidity in the market is now fully drawn, and the Federal Reserve may be willing to prevent pushing the market liquidity lower than the actual levels, especially given that the economy is not in a super position right now. So if that's the case, if this week's much expected and fully priced in 25 basis point cut from the Fed is sweetened by the announcement of the end of the quantitative tightening, equity bulls will find no reason whatsoever to reverse the actual market rally. The short-term yields and the US dollar would further be pushed lower as well as a result of a dovish Fed decision this week. And inside equities, AI and technology names continue to dominate the headlines this week. While we are waiting for the big technology earnings that are due Wednesday and Thursday this week, Qualcomm was that stock that actually stood out at yesterday's trading session by announcing that they will release AI chips to compete NVIDIA and AMD in this exploding AI chip market. So their AI 200 and AI 250 chips will go on sales as early as next year. And the Saudi AI company Humain will be their first client, a big client. NVIDIA and AMD could have felt queasy on the news, but no. Both rose around 2.7 to 2.8% yesterday as optimism grew that chip appetite is only increasing and there is probably enough cake for everyone to have a big slice. So Qualcomm, on the other hand, obviously rallied yesterday. At some point, it was up by more than 20% and it closed the session some 11% higher. In the coming days, as I said, we will find out the big technologies spending plans in the US that will directly impact the demand outlook for all of these companies that are building these AI chips. Note that together, Amazon, Microsoft, Alphabet, and Meta, these four companies are expected to have spent more than $100 billion in the third quarter, and most of the spending is in chips and data centers. So, bubble or not, the money is being spent, the rally is on, and it is not a bubble until it bursts. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.
This content is intended for individuals who are familiar with financial markets and instruments and is for information purposes only. The presented idea, including market commentary, market data, and observations, is not a work product of any research department of Swissquote or its affiliates. This material is intended to highlight market action and does not constitute investment, legal, or tax advice. If you are a retail investor or lack experience in trading complex financial products, it is advisable to seek professional advice from a licensed advisor before making any financial decisions. This content is not intended to manipulate the market or encourage any specific financial behavior. Swissquote makes no representation or warranty as to the quality, completeness, accuracy, comprehensiveness, or non-infringement of such content. The views expressed are those of the consultant and are provided for educational purposes only. Any information provided relating to a product or market should not be construed as recommending an investment strategy or transaction. Past performance is not a guarantee of future results. Swissquote and its employees and representative shall in no event be held liable for any damages or losses arising directly or indirectly from decisions made on the basis of this content. The use of any third-party brands or trademarks is for information only and does not imply endorsement by Swissquote, or that the trademark owner has authorized Swissquote to promote its products or services. Swissquote is the marketing brand for the activities of Swissquote Bank Limited, regulated by FINMA, Swissquote Capital Markets Limited, regulated by SISEC, Swissquote Bank Europe SA, regulated by the CSSF, Swissquote Limited, regulated by the FCA, Swissquote Financial Services Limited, regulated by the Malta Financial Services Authority, Swissquote MEA Limited, regulated by the Dubai Financial Services Authority, Swissquote PTE Limited, regulated by the Monetary Authority of Singapore, Swissquote Asia Limited, licensed by the Hong Kong Securities and Futures Commission, and Swissquote South Africa Limited, supervised by the FSCA. Products and services of Swissquote are only intended for those permitted to receive them under local law. All investments carry a degree of risk. The risk of loss in trading or holding financial instruments can be substantial. The value of financial instruments, including but not limited to stocks, bonds, cryptocurrencies, and other assets, can fluctuate both upwards and downwards. There is a significant risk of financial loss when buying, selling, holding, staking, or investing in these instruments. Swissquote makes no recommendations regarding any specific investment, transaction, or the use of any particular investment strategy. CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. The vast majority of retail client accounts suffer capital losses when trading in CFDs. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. Digital assets are unregulated in most countries and consumer protection rules may not apply. As highly volatile speculative investments, digital assets are not suitable for investors without a high risk tolerance. Make sure you understand each digital asset before you trade. Cryptocurrencies are not considered legal tender in some jurisdictions and are subject to regulatory uncertainties. The use of internet-based systems can involve high risks, including but not limited to fraud, cyber attacks, network and communication failures, as well as identity theft and phishing attacks related to crypto assets.